Today, I want us to talk about tax-efficient investments that you can actually do in Kenya. Tax efficiency is a strategy that you use to invest in a way that guarantees that you pay as little tax as possible. The first investment that you could consider that is tax efficient right now in Kenya is retirement savings. The second investment that you can consider that is tax efficient, infrastructural bond. The infrastructural bond returns are tax-free. Obviously, you retain 100% of your proceeds from that particular investment. You could also consider like offshore investments. Hi everyone, welcome back to my channel and to another episode of Finance Friday. My name is Coach Susan, and as per usual, I'm very happy to have you back here. Now, we are shooting at Sarova Panafric Hotel. As I've told you guys, I've really been enjoying doing our shoots here. The hotel is perfect for business and leisure stay when in Nairobi. They have amazing conference facilities. I'm actually going to be doing an event here real soon. I'm going to take you through that on another episode. So they have very amazing conference facilities, and they are also conveniently located along Valley Road, which is very accessible from the airport, either via the expressway. So honestly, next time you take a vacation or you're in Nairobi, you could use the promo code in the description box to book your favorite Sarova hotel. So on today's episode, I want to talk about something that one of my clients and I had a discussion about some weeks ago. And I actually thought, why have I never talked about this on my YouTube videos? Now, today I want us to talk about tax efficient investments that you can actually do in Kenya today. This information may apply to Kenyans primarily, but I believe that if you just follow up on what we are discussing, you could also do research on your country, whether you're in Uganda, Nigeria, my South Africans. I know so many, we've been getting a lot of love from South Africa in the comment section. So I'm just going to take you through. So maybe I will actually be mentioning the investments. You could do some research and see what would actually be applicable in your country or in the zone where you are based. Okay. Now, what exactly is tax efficiency? Tax efficiency is a strategy that you use to invest in a way that guarantees that you pay as little tax as possible. Why do we want to pay as little tax as possible? Obviously, we want to do that so that we can maximize on the money that we retain as returns from the investments. Now, here in Kenya, this is becoming increasingly more important because with the recent changes on our deductions that we've seen over the past 2 years, and just general inflation and cost of living, you realize that honestly, we are retaining so little. So even when you're about to now get into the investment space, because investment returns are taxed, it is very important that you know, so which investments should I actually choose that would minimize the amount of tax that I actually pay from my investment returns. If that is something that you're interested in learning, keep watching. So I'm going to get straight to it. I'm really going to try to make this short and sweet. So the first investment that you could consider that is tax efficient right now in Kenya is retirement savings, or if you're self-employed like me, opening a personal pension account or a personal retirement account. Now, where does this tax efficiency come in here? Now, before actually maybe 2 to 3 months ago, we were actually getting like a deductible amount. If you are actually contributing to a retirement fund or a personal pension fund, you were allowed to deduct 20,000 per month. It was an allowable deduction. Now, what is an allowable deduction? So before you calculate the final tax that you're supposed to pay, whether that's in a business or even on your payee as an individual, there are things that you are allowed to deduct. You deduct your expenses if in the case of a business, and you know, even in the payee, there are a couple of things that are deducted. Now, if you're contributing to a personal pension fund, you're allowed, before you used to be allowed a 20,000 deduction per month, which ideally would result into around 240,000 per year as an allowable deduction. Now, I know they increased that amount from 20,000 to 30,000 now. So that's 30,000 per month. That's an allowable deduction if you are a member of a retirement fund. And when I say a retirement fund, I mean like a private retirement fund. So I don't just mean NSSF. I mean, let's say you're working with, let's say, I don't know, any of the fund managers that offer pension funds, like the insurance companies that have pension funds, fund managers that have pension funds. So you are going to actually be allowed 360. That's actually 30,000 times 12. Am I right? That's around yeah, I think that's around 360,000 if I'm not wrong. So that's ideally how much you're allowed in deduction. So what that means is that you know, the amount you will end up paying in tax is actually going to reduce, okay? Or rather, the final amount where tax is going to be calculated from is actually going to reduce. I think something else that I would also want you to know or to think about in the case of a tax efficiency of a pension fund is that investments within a registered pension scheme grows tax-free. So the other tax that you're going to encounter is at the point of the final payout, or when they're paying you your lump sum. That's ideally when you're actually going to be deducted the tax, okay? And even upon that point of retirement, you know, a lump sum withdrawal of 600,000 is actually tax-free. And even the monthly pension that you could literally be receiving, let's assume you actually do an annuity, you would ideally get taxed at a much lower rate than what we usually will see. For context, maybe let me give you context. Your typical money market fund, for example, deducts 15% withholding tax on your interest returns. So let's say your interest is 12% per annum. You've calculated the 12% per annum. Maybe it's come to 12,000. Out of the 12,000 you've earned an interest, 15% of that money actually belongs to tax, or is deducted or withheld as withholding tax. So those are the few ways in which a pension fund or a retirement account is actually tax efficient. Now, the second investment that you can consider that is tax efficient, and this is very, very popular amongst us Kenyans right now, is the IFB, or what we call the infrastructural bond. Now, returns from an infrastructural bond are actually tax-free, and this is as you know, stipulated in the you know, in the KRA you know, tax law when it comes to infrastructural bonds. So guys, I think this is self-explanatory. I don't know what else to explain there. Because the infrastructural bond returns are tax-free, obviously you retain 100% of your proceeds from that particular investment. So that actually makes that particular investment tax efficient. Maybe something else I can mention about the other bonds. I don't know if you guys have actually noticed this, but like, even for the FXDs or for the normal bonds, which usually attract tax, there is also a way that some of them are tax efficient. And from what I've actually noticed is that the short-term bonds, so let's assume it's like 0 to 9 years old, not all of them, but majority of them attract a withholding tax of 15%. However, the more long-term bonds, I've actually realized that like for the bonds that are much longer than 10 years. So we are talking your 11-year bonds, your 25-year bonds, they actually will attract a withholding tax of 10%. So in a way, a more long-term bond would probably be more tax efficient than a short-term bond, because the short-term bond attracts 15% withholding tax, while a long-term bond would potentially attract 10% withholding tax. So because of that, you've minimized the amount of money that you're paying on taxes. And remember, your taxes are charged on your actual returns. Okay, so that is another way you could actually take advantage of tax efficiency with the government bills. Now, the third investment that is tax efficient is actually the real estate investment trust. Now, if you didn't already know what a real estate investment trust is, very, very quickly, let me try and see if I can summarize it. But we also have a video about real estate investment trust that I could link down below. So a real estate investment trust is a collective investment scheme where the fund manager, in this case, pulls money from different investors and invests that money in real estate project. Depending on the kind of rate it is, you could come up with either a development rate, which is denominated as a D rate, and then we also have an income rate that is denominated as an I rate. I talked about all of these things on the video, so make sure you watch it. I'm going to link it down below. Now, why are rates tax efficient? Now, for two reasons primarily. The first one is that by law, actually 80% of the profits that real estate investment trusts rather earn or make, the profits that they actually make by law they should be paid out to the investors as dividends. Now, this particular dividend is only taxed at 5%. The withholding tax applied on the dividend is 5%. Now, obviously, in comparison to like the 15% withholding tax on some of the investments like the money market fund or even some of the bonds or the bills, this is pretty lenient. It's pretty good. So your dividends will only actually attract a withholding tax of 5% as opposed to the usual 10 to 15%. Another reason why real estate investment trusts could be tax efficient is that for the listed real estate investment trusts, specifically the ones listed on the Nairobi Stock Exchange, like the Fahari one by Ilram, actually does not attract any taxes on the capital gains, because remember, you earn in two ways when you invest in real estate investment trusts. You earn from the dividends, but you also earn from capital gains. So if you actually get a real estate investment trust that is listed in the NSE, any capital gains you make from that particular investment are actually tax-free. So that pretty much makes real estate investment trusts some of the most tax efficient investments to consider or to think about. And maybe in this portion, I'd like to address something that, and again, another client of mine asked me. We were trying to talk about how she could diversify into real estate investment trusts as one of the investment options. And we had a very interesting discussion where she was asking me, Susan, I can get a money market fund that can give me 13%. While this real estate investment trust could potentially even give me 8 or 9%. Why in God's name would I actually go for the real estate investment trust? Well, I could get a higher return in the money market fund. So this is one of the reasons that I gave her. Honestly, I don't think we can compare any investment with another because different investments work differently. However, the real estate investment trust in this case, for example, is a good avenue to diversify away from the typical financial markets. And like I was even telling her, I was giving her an example. If anything was ever to happen to like the financial markets, for example, either because of like, let's say a government default or, you know, those things could happen. They've never happened in Kenya, so don't panic, but they could happen. People who have actually diversified into real estate, either through actual real estate or even, let's say, the real estate investment trust, you'd be operating in a different market. So maybe even you wouldn't even be affected in that case in point. But also on top of that diversification aspect, there's this aspect of the fact that real estate investment trusts are actually a bit more tax efficient than, let's say, your typical money market fund. Obviously, they work differently. We're not trying to compare or say you should do one for the other. If you can, pretty much you could even have both. So yeah, rates are tax efficient. The fourth tax efficient investment that you could actually consider is definitely dividends from the NSE listed stocks, and also dividends from saccos. Literally anything that gives you dividends is actually tax efficient, because most dividends in Kenya are actually taxed at, again, a 5% withholding tax, in comparison to the 10 or 15 that is typical in the mutual funds or unit trust funds, or even in government bills and bonds. So obviously capital gains are not also taxed in the stock market, because remember, the stock market gives you capital gains, but it also gives you dividends. So if you're getting any dividends from your stock market investments, let's say you bought Safaricom shares, EABL shares, maybe you even have dividends from your own sacco. Like personally, I'm in Stima Sacco, pays very good dividends. I know other people who are like in different SACCOs. If you're in a very good SACCO that pays very good dividends, most of these dividends are actually taxed at 5% withholding tax. So because of that, anything that gives you dividends, actually, we could consider it as tax efficient. Remember, tax efficiency, as per our definition earlier on, is a scenario where you're paying as little tax as possible to maximize on the return that you actually get to keep. All right. Now, the last thing. Now, this is not an investment. Okay, guys? It is not an investment. So let me start with that disclaimer. Okay. So I've talked about 4 investments that are tax efficient. Now, the 5 is the 5th option is not necessarily an investment, but it is if you diversify your portfolio in such a way that you have this investments that we have actually discussed, the 4 investments, and then you actually diversify into having an insurance portfolio. Having an insurance portfolio is actually tax efficient, because obviously your life insurance, for example, as a tool of, saving for the long term, or planning for legacy planning, or protection, your protection portfolio, they actually do not attract things like withholding tax. So this is one of the, you guys know we've had this discussion. I don't even want to get into insurance conversations again. We have already had them. The next time we are going to see me having this conversation, we'll be having it with an expert in the insurance field as well, just to get a different opinion. However, if you actually have a protection portfolio through insurance products, then you are already doing something that should be considered tax efficient, because whatever money you're directing towards your insurance portfolio is actually not attracting any form of tax. And because of that, that actually makes anything under that insurance umbrella, or anything in your insurance portfolio, specifically the life insurance products, tax efficient. Okay, so I really hope that you've gotten and learned something. Those are your 5 options that you can consider for tax efficiency. Obviously, maybe to mention this as a conclusion, you could also consider like offshore investments. And I think maybe we can do that on another episode. Please let me know in the comment section if this is something you'd like to learn about, because I could also take you guys through some offshore investment options that are not primarily like within the Kenyan jurisdiction, that could also be tax efficient. And one of the reasons why they could be tax efficient is because you will find that some countries usually have tax treaties, or there's a scenario where they don't want to do like double taxation. And because of that, you could actually be investing in investments that are outside of Kenya, maybe even outside the continent, global investments or offshore investments that could literally result in you paying less taxes. So if this was useful and you would like me to have this conversation further, maybe do a video where we talk about offshore investment options that you could consider, please let me know in the comment section down below. I really hope you enjoyed today's episode. In case you have any questions or comments, you know what to do. Drop them in the comment section down below. And that's it. I'm gonna see you on the next episode of Finance Friday, so stay safe.